Good afternoon, everyone, and welcome to our presentation with Left Brain Professionals, Lay the Foundation of Government Contract Accounting. We're really glad that you chose to spend some time with us today, and I know that you'll enjoy the program. My name is Liz Brigson. I'll be your host, and I'll review our housekeeping items briefly before I pass things over to Robert to get us started with the program content. First of all, we really like to make the webinars interactive. So if you've had a chance to join us before, you probably know exactly where the questions box is. And if you haven't had a chance to join us before, go ahead and head on out to your GoToWebinar control panel, look for that questions drop down, and go ahead and type in, let us know if this is the first government webinar you've had a chance to join, the first government accounting webinar, or perhaps you've had a chance to join us before. Robert has presented with us previously. It looks like this is Deborah's third, so that's awesome. Wonderful. It's Marilyn's first, Allison's first as well. So welcome, everyone. We're really glad to have you with us, whether you have joined previously or this is your very first time. Next, I'd like to draw your attention to the handouts. So the handout section is also part of the GoToWebinar control panel. You can go ahead, drop that down, and download the handouts. I know you'll want to reference them today, and even more importantly, in the future. You'll also be able to access the handouts from your Incorsa dashboard as well. Robert has a 1-hour webinar planned for you today. So there will be 4 polling questions. To earn CPE credit, you'll want to respond to at least 3 of those 4 polling questions. And even if you don't need CPE credit, it's always great to have audience participation. So we hope that you'll respond to those poll questions. If you have any questions at all about the webinar today, you can always email us at support@incorsa.com. And you can connect with me. I'd love to connect with you on LinkedIn as well. All right, so with that, it's my pleasure to introduce you to Robert Jones. Robert is the founder of Left Brain Professionals, and he is a government contracts and accounting expert. He has a really fantastic professional background. He has a master's in accountancy. He's held roles including business management, compliance operations. He's been a controller. He's managed defense contracts, and Robert has really brought together all of that experience into Left Brain Professionals, which is consulting, helping firms and companies that manage government contracts do that optimally. So Robert's a phenomenal instructor and speaker. We're really glad to have him here with us today and really appreciate Left Brain Professionals for sponsoring this content. So Robert, welcome back. Thanks for being with us, and I'll hand things over to you.
Well, good afternoon. Thank you very much. We appreciate again the opportunity to be here. A little quick about who we are. We are a boutique accounting firm. We happen to be located in Columbus, Ohio. We work strictly with government contractors, and we practice primarily accounting system design, implementation, and audit support. Me and another one of my colleagues there, Melissa, she will join me in part of this series, and I should pause for a moment and say that for 2020, this is presentation number 1 of 12 that we'll be delivering in a series of government contract accounting with the goal of covering government contract accounting kind of from end to end. Today's presentation on Lay the Foundation might be a little basic for some of you, but it is a reminder and again is designed to set the framework for where we'll move forward from here. Get a little more about what we are and some of the things that we do. One of the big things, and we'll talk about this in some future presentations, is indirect rates. We really do a lot helping clients understand their cost structure and developing solutions to maximize profit. Without further ado, let's dive into today's topic today of Lay the Foundation. If I do my job and do it well at the end of the presentation, you should be able to list the basic principles and regulations for government contract accounting, explain the importance of segregating direct and indirect cost, describe the common cost pools, and be able to draft a basic government contract chart of accounts. All right, so what are some of the basic regulations? Well, first and foremost, everything we do is still GAAP, generally accepted accounting principles. Accounting 101 here. The reason I highlight this a little bit is one of the questions we often get for people who are unfamiliar with government contract accounting. When we start talking about the federal acquisition regulation, cost accounting standards, and things we'll introduce here in a few more slides, sometimes the questions we get are, well, how does that align with GAAP? Well, it really is just another layer on top of GAAP. And you will find that nothing that we discuss today or discuss in the future in regards to government contract accounting and the specific requirements for contractors, none of that is going to be in violation of or otherwise counterintuitive to GAAP. With that, again, just a quick reminder here, we'll go through a few slides on the 10 basic principles of GAAP. Right, so we have the economic entity principle, and it's really interesting to point this out, particularly because we deal with a number of very small clients in what we do. Again, because we work strictly with government contractors, our client base is a little different. We are lucky enough to have a couple of Fortune 500 companies in our client base, but a significant portion of our clients are small. Some of them so small of maybe only 2 or 3 employees. As some of you may know, what happens in that case is oftentimes the owner is the business and the business is the owner. It certainly seems that way. And they often have difficulties, right, separating their personal life from the business life, and even more so in the accounting, especially as they take draws. Many of them have personal credit cards that they're using to fund the business, right? And things like that get a little squirrely in trying to keep everything straight. So we always have to make sure that the business is its own entity, complete and separate from any of the owners. Everything that we do will be in U.S. dollars, right? And the effects of inflation are ignored on previously recorded dollar amounts. We still have to be concerned about time period principle. Right, we always, whether we're any of our reports, we always have to reflect whether that report is talking about a week or a month or some other calendar or fiscal year. It's kind of interesting to note here that certainly in the government contract space, you still have a number of clients who do follow the calendar year. However, because they are in government contracting, you do have some clients who elect a physical year that aligns with the federal government's physical year of October 1st to September 30th. And then we also have some clients who elect to have a physical year that aligns with some of your state physical years, and many of those state physical years, because they do a significant amount of state government contracting, those state physical years are often July 1st through June 30th. All of our assets must be recorded at the cash amount or the equivalent at the time the asset is acquired. Again, none of this changes for work that we're doing for government contractors. Full disclosure principle, right? We need to make sure that the information is pertinent to an investing or a lending decision. And in fact, again, one of the things that we're often doing with some of the small businesses we work with is getting them to the point of being able to go to a bank and get a line of credit. As they tackle larger contracts, as their company is growing, oftentimes they need that line of a line of credit in order to be able to fund payroll and other purchases, right, as they're waiting to get paid. So we have to help them get that stuff straightened out. Going concern, right? Are they going to be liquid in the foreseeable future, right? And they have no intention to liquidate the business. Matching principle is always, again, another interesting one. I think it's probably true inside and outside of the government contract space, though in some ways I think it seems to stand out with government contracts. The issue here that we have found with many new clients that we work with, government contracts, especially if they're doing fixed price contracts, not uncommon for some of those contracts to be contracts that span multiple months. And as a fixed price contract, it might be, and often is, a situation where they bill the government or bill their prime, if they're a subcontractor, at the completion of that contract. So for example, they might have a 6-month contract and they're not able to invoice for that contract until they've delivered all the products or services associated with that contract. But as we all know, in that 6-month period of performance, right, they're incurring all of those expenses, whether it's labor, materials, travel, ODCs, maybe even some subcontractors along the way. And so what we have found is that we will look at the monthly financial statements of a client and see some pretty significant swings. Quite often you'll see loss, 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 huge profit, loss, 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 huge profit, because they may be recognizing, and quite often are recognizing a mixture of cash and accrual-based transactions. They think they're being accrual-based because they have accounts payable and some accounts receivable, but then they record some transactions from a cash basis, right, of when they actually spent the cash and when they received the cash from, or when they invoiced the client, right? So in month 7, at the end of 6 months, when they've actually completed the work, they invoice, and so they're recognizing revenue, for example, at a time when maybe they should have been recognizing revenue either throughout the 6-month period, or maybe they actually can't recognize revenue till the end, so they should have been accruing the expenses and then recognizing all the expenses at the time that they recognize the revenue. Again, I'm sure we see this in clients outside of the government contract space, but the very nature of government contracts seems to exacerbate this issue. In conjunction with the matching principle, right, is revenue recognition. We know there were some recent changes to that. Again, what we find is that many small businesses really get hung up on recognizing revenue at the time that they issue the invoice and or when they receive the cash, not necessarily when they truly earned the revenue. And again, a problem often exacerbated by the very nature of government contracts. Materiality, right, is still always something that we have to think about when we're trying to, I always think about when we're trying to solve problems, right? We end up spending dollars chasing nickels and dimes on a report or a financial statement, right? So we have to sometimes think about that. It's also interesting when we get, and it's going to be farther down the road when we talk about the incurred cost proposal, DCAA, or the Defense Contract Audit Agency, has actually given us guidelines for materiality as it relates to that specific audit. So again, it does not conflict in any way with GAAP, but they've gone so far as to clearly define what is material and provided a formula or a calculation so that as you're working on each individual audit, you know what is considered material for that particular audit. Conservatism. We have to make sure that we report an item or recognize potential expenses and liabilities immediately, right, anticipating any losses and choosing the alternative that will result in a lesser net income and or a lesser asset amount. All right, so with those 10 basic principles out of the way, I'd like to introduce the Federal Acquisition Regulations, or the FAR, and their appropriate supplements. You can find the FAR and other related information at acquisition.gov. Here I'd like to say that near the end of the presentation, you'll see a slide where you can go to our website to download this presentation. Also on that page, when you get to our website, we have direct links to a lot of the, to all of the resources that we talk about today. So you don't have to be as concerned about trying to capture that. We do provide those links to you, and we don't ask for anything in return. You can simply go there, click on the link, and get the information. We don't collect your name or email address or anything. So again, here, the Federal Acquisition Regulations, you can find them at acquisition.gov. If you go there, you will also see the opportunity to see the supplements. One of the primary supplements that many contractors deal with is the DFARS, or the Defense Federal Acquisition Regulation Supplement. As many of you know, the Department of Defense is the largest portion of the federal budget. And so as we deal with government contractors, more often than not, many government contractors deal with defense, maybe solely, or at least as part of their portfolio of dealing with the federal government. Now, the FAR here includes a number of clauses that deal not only with accounting policies and cost and pricing procedures, But there are a number of other things in there related to materials, employment law, various other statutes that are required to be enacted or that are required to be followed as part of federal acquisition. So when you go there, you'll see a bunch of other stuff, but you will definitely find information about contract types, how they affect accounting and such. The other set of regulations are the Cost Accounting Standards, or CAS. You will hear, if you're in the government contract space, you will hear us refer to CAS. These are a set of requirements that were designed to level the playing field of all government contractors by defining the treatment of certain types of cost. So as you know, with GAAP, and when we're dealing with companies, oftentimes they have electives in how they treat cost. That still is true, again, with many government regulations. But there are some that the government has clearly defined how they shall be treated, or again, they've given you a very clear options of maybe a couple of options to choose from. We do have an entire webinar dedicated to CAS in the future. It's such a deep topic that we could actually probably spend an entire day talking about it. But these webinars on here, when we have roughly 60 minutes together, are meant to be more of an awareness and to highlight specific aspects of each of those topics. All right, with that, Liz, I'll ask you to kick off the first room poll for us, please.
That sounds good. So that was a really good run through of the 10 principles of GAAP. And this first polling question is, which of the following is not one of the 10 principles of GAAP? So this is a nice little refresher, and I think it's great to always start with, that common knowledge and just go through to refresh and then build from there. And that's really how you titled the webinar too, isn't it?
Yep, we got to deal with the foundations in everything we do. And as you said, sometimes I know it's always helpful for me. Sometimes when I go back, oh yeah, I forgot about that little tidbit of information in there.
Definitely. So we're going to go ahead and close this poll down, and let's take a look at the results, because it looks like this is a really beneficial refresher for everyone. So which of the following is not one of the 10 principles of GAAP? And Robert, you want to just take a minute to review and recap what we talked about?
Yeah, so I think monetary unit was number 2 on the list. Conservatism was one that we talked about. Revenue recognition is definitely a topic. But interestingly enough, in everything that we talk about, accuracy, while I think probably all of us are accurate freaks in what we do, accuracy is not one of the 10 principles. So,
and I think that's, it almost seems like a trick question, right? Because we always care about efficiency and effectiveness and accuracy, but that's really where materiality comes in, right?
That is correct, yes.
So we'll go ahead, put the results away, and I'll pass it back over to you for your slide deck.
All right.
There we go.
There we go.
Perfect.
All right, so the second learning objective for us today is on segregating costs. Let's get the basics out of the way. Let's talk about segregating costs, and particularly what I'm talking about here is segregating direct and indirect costs. This is a big issue for government contractors. It should be a big issue for everybody, right? So we talk about direct costs. Let me also say here that this really is the same as cost of goods sold, or COGS. In the government contract space, we tend to use the term direct costs. That's how they are referred to in the government regulations. But we are talking about COGS, or cost of goods sold. So why does the government care specifically about segregating direct and indirect costs? Well, they only want to pay for their own portion of direct costs, right? So if you are a government contractor and you have multiple clients, maybe a mixture of government agencies, state and federal, maybe a mixture of even some commercial clients in there, right? I would suspect that your commercial clients don't want to pay for the direct materials you put on a state or a federal government contract. And likewise, the federal government doesn't want to pay for direct materials that you put on a commercial contract. That seems pretty straightforward. But they also only want to pay for their fair portion of indirect costs. And as you will see throughout, we'll talk a little bit today, but as we advance through this series and we get into a couple of upcoming sessions on indirect costs, you will see that the direct costs form the base of the allocations for those indirect costs. So it's very important that we get the costs into the correct pool and that we treat them consistently, another topic that we will discuss. But it's important that they're in the correct pool because they affect how we calculate our fringe, overhead, and G&A that we'll talk about later. As I said here, they do become the base or the denominator for things like fringe, overhead, G&A, and material and subcontract handling. I know that many in the commercial space are used to having cost of goods sold and overhead, or some companies will say cost of goods sold and SG&A, their sales, general and administrative. Some, again, might break out overhead and G&A separately, but it's not uncommon when we're dealing with commercial clients who come, that maybe it's their first foray into government contracts and then they end up working with us. They have their cost of goods sold and then they have everything else in overhead. When we're dealing with government contractors, and as we dive into this, I think you'll see the advantages that commercial contractors or commercial clients could benefit from actually segregating out that overhead into multiple indirect pools for, again, fringe, overhead, G&A. And this material and subcontract handling really is something unique to government contractors. Costs must receive consistent treatment. And you see here that I referenced CAS 401 and 402. I'm going to pause for a moment and back up to discuss CAS. So when we talk about CAS, you will sometimes hear people say, well, they're a CAS contractor. No, a contract itself may be CAS covered, but the contractor is not CAS covered. In fact, a contractor may have a mixture of CAS and non-CAS covered contracts. They may be in a situation where they have a contract that is what we refer to as full CAS or modified CAS. And again, we have a full presentation coming up in a couple of more months where we will dive into the specifics of CAS. The other thing that's important to note here about CAS is that even though a contractor may not have any CAS covered contracts, CAS is still used as a best practice guideline, and it is still referenced by auditors for almost any kind of audit that you go through with the government. They're certainly going to use CAS, even if it's not a CAS covered contract, they're going to refer to that and use that as a guideline for their evaluation and recommendations. And that is certainly true here when we talk about CAS 401 and 402, which deal with the consistent treatment of costs. And so in this consistent treatment of costs, remember right now, we're talking about segregating direct and indirect costs. What this means is that once you determine a cost to be either direct or indirect, it must always be the same. And let me give you a prime example. Many companies will agree that the buying function, right, people who are buying materials for internal use on projects, or they're buying specifically for customer projects, most clients will agree that buying is an indirect function, right, part of overhead, because they're buying for a bunch of different projects. They're also buying for internal stuff like toilet paper and office supplies and other things. And so they'll agree that, again, the buyers is an indirect part of an overhead function. Until such time that the small company wins this huge government contract and they say, hey, wait a minute. Now all of a sudden we've won this big contract that's going to double our business. And by the way, that's not uncommon for a lot of small contractors. They get in on a small government contract, they prove themselves, they take the risk of bidding on a large government contract and oftentimes surprise themselves by winning it. And that surprise may come again in the form of, we often see many small companies double and triple their size in a very short period of time. And so they'll win this contract, and now all of a sudden they're going to say, okay, I've got this buyer, and now all of a sudden this buyer is going to spend 50% of their time. They're going to spend 20 hours a week just buying for that one contract. And the other 20 hours a week, they're going to spend buying for all these others. So and this is often the owner of the company that we're talking to, and they'll say, okay, so now what I want to do is when Sally over here, the buyer, is doing her job, the 20 hours that she's doing directly for that one specific project, I want her to charge direct. And when the other 20 hours when she's doing stuff, I want her to charge indirect. And the answer to that is no, no, no. If the nature of her work is that she's still buying, regardless of the fact that, yes, we can agree she's spending half of her time on one particular contract, if the nature of the work is still the same, once you determine that cost to be an indirect cost, then it's always an indirect cost. Now, the only exception to that is companies are free to make changes to their accounting structure, right? So we may find that we made an incorrect decision in the past, or maybe we were inadvertently inconsistent, or we realize right now, maybe because of the shift in something, that we can make a better decision. And so a company certainly can change its accounting practices going forward. You just can't treat them differently within the same period, and you certainly can't be flipping back and forth from year to year. All right, another quick polling question here, Liz.
Sounds good. That one came pretty quick. So now we're going live with this next poll. What's the #1 reason for segregating direct and indirect costs? I like this first answer here because Robert said so.
Exactly. That should be the answer, right? Just because I said so is all you need. That's what my mom always used to tell me. Because I said so.
That's right. Yeah. So we'll leave about 10 more seconds for this poll question. And I don't recall it being one of the 10 principles of GAAP. So hopefully that helps narrow it down to either.
I was going to say, hopefully we've narrowed away 2 of the options here for people.
Like, who wants to be a millionaire? Okay, so the poll responses are now up. And how did
yeah, I was going to say, it looks like about half the people got it right. I will say that required by the IRS certainly was a bit of a trick one that I put in there, because oftentimes when we talk about accounting, if you think, well, it must be required by the IRS. No, it's actually not required by the IRS. But the government only wants to pay for their direct costs, right? That was one of the things that we mentioned on one of the first slides.
Yes, definitely.
All right, are you?
Yep, so we went ahead to close the results, so that should be right back over to you. And I think you pop up your PowerPoint.
Yeah, we're having a minor issue here. Give me just a second. There we go.
There we go.
Not sure what happened, but all right. And I'm working from a Mac, which is relatively new to me, so some of the functionality is a little different than PC. Yes. All right. The number 3 here in our learning objectives was about cost pools, and I briefly introduced those on a previous slide when I said the fringe, overhead, and G&A. So we'll do a little bit of a deeper dive here. The first one is the direct, or again, as I said earlier, direct is what we call it in the government contract space. Really is just your cost of goods sold, or COGS, what we're typically used to. These are costs, and so there's some interesting terminology here that are directly attributable, and this is the phrase, directly attributable to an end cost objective. And you will hear that phrase, end cost objective, or you will read that phrase if you dig into some of the regulations. And so what is an end cost objective? It's a contract or a job/project, depending on what your system calls it, or an end product or service that you make or deliver. All right, so again, very clear. If you could have 3 projects, for my example, let's say you've got a federal contract, a state contract, and a commercial contract, and you're building, let's say you're a construction company and you're building 3 buildings, 1 for each of those clients. Well, obviously, if you order a truckload of lumber, for the federal contract, you want to make sure that that truckload of lumber, right, gets charged to the federal contract job, because that is the end cost objective. And we knew when we bought that lumber that it was being purchased specifically for that job. So now those costs need to be aligned, again, with that end cost objective. From there, we get into our indirect pools, and the first one that we talk about is fringe. I describe this as the cost to maintain, and notice that I put in bold here, W-2 employees. This is the trick here, folks. It's W-2 employees. So when we, in the future presentations, we talk about calculating our fringe rate and defining what our cost pool and cost base is, our base for fringe will be W-2 wages, our W-2 labor. That means our employees. And if you step back and think about that for a moment, it kind of makes sense, right? Because the things that I have listed here for the fringe pool are things like employer taxes, paid absences, so things like PTO, holidays, vacation, bereavement, jury duty, our health insurance, again, whether it's health, dental, life, short-term disability, long-term disability, all of those things, retirement, whatever form that may be. All of those things, again, and think about that as, notice the other word that I used up there in the description. It's the cost to maintain employees, not a cost to hire or attract employees, right? These are HR costs that go somewhere else. This is once somebody is actually our employee. And again, just to drive home that W-2 aspect of this, note that, and again, if you step back and think about this, if you had temporary labor that you were hiring from Robert Half, for example, would you be paying their employer taxes? No. Would you be paying for their paid absences? No. Right, that's what you pay Robert Half for. Now, indirectly, you're paying for it, right, because Robert Half includes that in their markup to you. You know, they might be paying somebody $20 an hour, but they might be charging you $30 or $40 an hour, right? Because they are paying those taxes. They are paying for time off, health insurance, or other things that their temporary employees are eligible for. Same thing with subcontractors. Again, your subcontractor is responsible for paying their own employer taxes, health insurance, and stuff. So none of that subcontract labor gets calculated in here. With that, I always like to make sure that we have, and we'll talk about homogeneous accounts here in a little bit, we want to make sure that we have clearly defined descriptions for all of our accounts so that it's easy to identify the subcontract labor separate from, I should say subcontract labor and temporary labor separate from our internal W-2 labor. The second pool that we talk about in government contracts is overhead, and I'm going to flip back and forth between a couple of slides here and kind of talk about overhead and G&A together. Again, this is one of the common questions that comes up because we have many clients who come to us. They've already been in the commercial space for a while. They're just now starting to sell to the government, or at least getting bigger in the government space. And so they said, well, we've always just had overhead. What's the difference between overhead and G&A if you're going to take time to separate these things out? All right, so overhead are the costs to support customers and products or services. These are costs that, note, are not directly attributable to an end cost objective. Remember when we talked about direct that I said that those costs were directly attributable to an end cost objective? Overhead costs, right, are not directly attributable. So those can be things like product support, right? We're actually supporting an entire product line, not a particular product, or not a particular product bought by a specific customer. Now, while we may have a help desk, or whether it's a telephone or a chat or email, right, where we do respond to specific customers and helping them with the product that they purchased, we're generally providing product support across the board and often pointing them to the same set of resources. So there's no one particular customer or product that is necessarily, that's benefiting from that work. Another item in overhead is idle time. And my description for idle time or example of idle time, let's say you got a manufacturing facility, it's Friday afternoon, you've run out of, or you're not otherwise maybe not prepared, maybe you don't have the materials in stock to continue doing direct work. But your employees only have 36 hours in, and so it's Friday afternoon, you want to get them their 40 hours. And so you say, okay, we're going to take time to clean and organize the tool crib, and we're going to clean and organize, the inventory area. Maybe we're going to do some other general work around the shop to get prepared for next week, right? None of that work that I just described is actually going to any specific project or customer or product. So that, and the term, we use the term idle time, but we say that because, right, it's just not, it's time that's not being utilized directly for customer work. Training time or training expenses, and that can include labor, the cost of the training class, if there's travel associated with the training class. Things like our facilities, so rent, depreciation, utilities, maintenance, repairs, insurance, all of that kind of stuff would go into overhead. And then all of our equipment, and again, whether it's actual purchases of equipment, the depreciation, repairs, and maintenance, stuff like that for the equipment that, again, we're using to build a lot of products, or that we're using that equipment to service a lot of different customers. So G&A now, in comparison to overhead, G&A I describe as the cost to run the business regardless of the number of customers. And if you look at the items that I have here for things like business development, marketing, accounting, HR, and IT, those are expenses that, you would have those people regardless of the number of customers, the amount of revenue that you have, right? You're still going to have those functions that are necessary to run the business and keep the business running. So again, really quickly, overhead are those costs of supporting customers and products or services, and G&A are those costs to run the business. So a couple of other things that we'll talk about, unallowable costs. And again, this is a concept that really is unique to government contracts. We have an entire webinar coming up probably in the summertime for you as part of this series. Again, it's a topic that could probably almost be a full day seminar. There's a lot to talk about. In simplest form, the government has identified costs that they deem are not necessary for you to incur in order to deliver your products or services to the federal government. These are outlined in FAR, the Federal Acquisition 31. So again, if you go to acquisition.gov, on your screen on the left-hand side, there'll be a little grid. You could click on 31 and get into FAR Section 31 to read about them. A few of the items that I've listed here, alcohol. So essentially the government says, right, you as a contractor, as a business might say that it's okay for your employees to have a beer with their burger when they're traveling, right? So lots of times we have employees who travel. We're going to reimburse them for that. Those expenses may be tax deductible, right? I have to say maybe. A lot of stuff has happened with meals and entertainment. And also, we don't practice taxation, so always, always, always talk to your tax CPA about this stuff. These expenses may, and many times are, still tax deductible for IRS purposes. They're simply not includable or allowable in your billable rates back to the federal government. One of the other ones is interest and finance charges. So that includes things like interest on loans, interest on line of credit. If you have a credit card and you're running a balance and paying interest or finance charges on there, those kinds of things are not allowable, and you cannot include those costs, again, back to the government. Charitable contributions, I always encourage companies that even though these may not be allowable, right, we still need to be good stewards in our communities. One of our things that we do at Left Brain Professionals, I personally have taken on hunger as something very important, near and dear to my heart, and we make significant contributions to our local food bank, but some other food banks and other food initiatives across the U.S. it's a good thing for us to do in our community and being a good neighbor. There are some intermediate cost pools, and in fact, the 2 dates that you see here coming up next month, we'll dig into fundamentals of indirect rates. So we'll actually do a much deeper dive on the fringe, overhead, and G&A. We'll talk about the different allocation methods that are included there. And then in March, we're going to talk about advanced indirect rates, and we'll dive a little deeper into the intermediate aspect of that. And you should see links to register for those in the next couple of days. All right, with that, Liz, I'm going to kick it over to you for our third polling question here.
Sounds good. So true or false, government contractors can have as many cost pools as they want. So let's go ahead and leave this open for about 10 more seconds.
Yeah, I'm curious. So I kind of hinted at where you may get this answer. I didn't really address it directly. So let's see how attentive people were.
Yeah, so we're gonna close this down. And it's almost a 50-50 split. So I'll share the results out. 44% of the audience says true, 56% of the audience says false.
And the answer is true. You, as government contractors, you can have as many cost pools as you want. And in fact, you'll see that when we get into that advanced class in the future, that we will be talking about how and why exactly companies will split their fringe and overhead and G&A into multiple pools. So the answer is true. They can.
Oh, and I'm sorry to interrupt you there, but I'm guessing just because it's allowable might not mean that a company would want dozens. Yeah. There's probably a fine balance there.
There is, and the phrase that I use is you can become a slave to the system. There are certainly valid reasons why companies want and need to have multiple cost pools and rates. But as with anything, right, when you start to build that out, then somebody has to maintain it over time. And sometimes that cost of administration doesn't make sense for some smaller businesses.
Thank you.
All right, so let's get in and talk about our last learning objective here, which is that you should be able to draft a GovCon chart of accounts at the end of today's session. And then we'll be into some Q&A here before long. All right, so again, a little bit of foundation stuff here. General ledger accounts, I think we all agree, are the foundation of our accounting system. All the transactions, reports, policies, and procedures that we have all revolve around that chart of accounts, right? Every transaction, whether it's dollars or hours, eventually gets put into the general ledger. The general ledger is made up of accounts. And so then obviously all the reports that we generate are based on those accounts. And our policies and procedures, and I will say if they are well written, will have certain references, right, to specific accounts and account groups, right, as to how we treat certain types of costs, right? If you have well-written policies, accounting policies and procedures, then I should be able to pick them up. If I come to work for you and I say, okay, how do they treat travel costs? I should be able to go to the travel section. You tell me how you treat the costs. And there should be some references as well to either a section of the chart of accounts or some specific account numbers of where those costs should be posted. Individual accounts must be homogeneous. So a little reminder, what does it mean to be homogeneous? It means containing only one type of expense. Prime example, and one of the real problem areas for a lot of companies is labor. So a couple of things will end up happening. We will often see clients who will have a direct labor account, and they will put their W-2 labor in there. They will put the temporary labor from when they call, Robert Half or somebody. I just pick on Robert Half, but when they call some temporary agency, particularly when that temporary labor is going to be helping on direct work, They may be subcontracting out a portion of that. Sometimes they'll dump that all in one account. Well, now all of a sudden you might say, well, it's all labor, Robert. Yes, but the nature of that labor is different. And so we would want to make sure that we actually have an account for if we really did have those three different sources of labor for our direct or cost of goods sold, we would want to have multiple accounts to reflect that. One for our internal labor, one for the temporary labor, and one for subcontract labor. Another area where this becomes problematic, and the example that I like to use is training. And so somebody will say, okay, we'll create a training account in overhead, because Robert said we should do that on one of those previous slides. So they did that, and they put it in the overhead pool, which is where it would typically go. And then somebody comes along, Sally, or my good friend Sally, who's working here. Sally comes along and wants to take a training class, and so it's a class that's in another city. And you guys know many of these training classes. It's not uncommon to be several $100s or even a couple $1,000s for the week. So we pay for the class, we charge that to the training account. Sally has to travel there, so she's got airfare and lodging and a rental car and meals, and we end up charging, because when somebody says, well, that was part of the total cost of training, so we should put that in the training account too. So they put all that in there. And then somebody comes along and says, well, she wasn't here working, so she shouldn't get charged in any of these other accounts. Her labor should go into that training. Now, I agree that we probably could have a training section in the chart of accounts, right, so that we could capture all of the training costs, and at the end of the year be able to go back and say our total training expense across the year and departments was some dollar, but we would want to have individual accounts for things like training labor, training travel, training class, right, where we'd actually pay for the seminar or the class itself. So if we end up with accounts where we are combining different types of expenses, a couple of things happen. Well, really the primary thing that happens is then it becomes very difficult to perform proper analysis on those accounts. And that becomes more problematic when we talk about our indirect rate structures in the future, because as I said, particularly with fringe, our base of fringe is always W-2 labor. And if we've got Sally's labor buried in an account with a bunch of other expenses, then it's going to be very difficult for me to extract the proper dollar amount out of that account in order to calculate what my fringe rate is. Similarly to homogeneous accounts, we also need homogeneous pools. So the ones that we've talked about so far have been fringe, overhead, and G&A. Fringe, again, being all those costs to maintain an employee. So all of the costs in the fringe pool, while I might have a series of accounts that are, that again are homogeneous in and of themselves, the pool should be homogeneous as well, and making sure that it contains only fringe expenses, right? Because if we inadvertently create an account over there that really is not fringe, then when we go to calculate our fringe rate, right now our fringe rate is not going to be accurate because somebody inserted an account in that cost pool that didn't belong in that spot. There is an industry accepted best practice here for numbering of accounts. If you've been in the government contract space, this may look familiar to you. I will say that on the left for the balance sheet, even a lot of commercial entities typically follow this, right? We put our 1s for assets, our 2s for liabilities, and 3s for capital or equity. Again, when we get over to 4 and 5, somewhat common, not quite as common, but somewhat common to kind of see that. But when we really get down into the 6, 7, 8, 9 aspect of breaking out all of those indirect costs is where we see many government contractors really kind of fail. Now, to be fair to everybody, can you properly calculate a fringe overhead and G&A rate if you don't have this chart of account structure? Yes, you can, right? As long as the accounts are otherwise homogeneous and are clearly identified, and I can, extract the data that I need, yes, I can still calculate an appropriate fringe overhead and G&A rate. But it gets more difficult because usually what happens, again, with a lot of smaller clients, they start sequentially numbering their chart of accounts. And for any of you out there who have built a new system or built a new chart of accounts, we usually try to build some logic into it. And again, this right here would be the very basic logic. And inevitably, somewhere down the road, invariably, right, the logic starts to break apart. But unfortunately, what happens is we see a lot of clients that they get to the sixes and they start dumping everything into six. And the next time they have a new account, they just add it sequentially in order without any correlation to the way the rest of the chart of accounts is structured. So they end up with the chart of accounts that's very difficult to follow and very difficult to then extract the appropriate data in order to perform the calculations. Then you won't, an auditor won't fail you on the government contract side if you don't have this. But I can tell you, if you do set it up like this, it's going to give them a level of comfort that, okay, they're headed down the right path. They've got their cost pools identified. I should then be able to go to all those 6 series of accounts and be able to know what's going on. The other thing that's really helpful, again, whether you're an auditor, whether you're preparing financial statements, whether you're doing data entry, with this structure, if I look at a client, if I'm working on something with the client's books or reports and I see a 6, then I know it's French. If I see a 7, I know it's overhead. If I see an 8, I know it's G&A. It's very easy, even without reading the descriptions, to know right off the bat what type of account it is. And then combined with that, when I do look at that and the description combined, if somebody has created a new account and either maybe created it incorrectly, they put it in the wrong pool, my brain will look at it and go, wait a minute, this is 6 series of account, but it says something about facilities. Why would there be a facilities account in the 6 series, right? So it's just another validation for me to go, okay, wait a minute, something isn't right here. All right, with the basic structure in place, it's easy to grow and add new accounts and to build indirect rates. That is everything I have for today. We'll do some Q&A after this last polling question here, Liz.
Sounds good. All right. So based on what you learned today, how much help do you need building your government contract chart of accounts? So we'll go ahead and leave this open for the audience to respond. And Robert, I really liked your point about the chart of accounts and using the industry best practice numbering, because that's just so helpful. It really gives auditors, whether they're financial statement auditors or government contract auditors, a sense of confidence, right, to see an industry standard point of reference for all of the accounts.
Yeah, I say somewhat jokingly that I can tell a lot about a company as soon as I get at their trial balance, right? And probably that's true for many of you as well, but it's definitely true for me in the government contract space. As we work with new clients, as soon as I get a copy of the trial balance and I look at it, and all of a sudden I see a bunch of 6s or a bunch of 7s, whichever number they've chosen, and it's just a hodgepodge mess, and then I know I'm going to have an interesting dilemma to dig through.
Very good. Well, thank you everyone for responding to that poll. It looks like we have some folks who consider themselves to be experts, and then about a quarter of you say we need a few tweaks. A couple people say we really could use some help, and then there's a group of people who are unsure as well. So with that, let's transition into our Q&A. And I think this was a fantastic topic to get started with the first of the 12 series that you're working on this year.
Yeah, so I'm opening my question panel. We got a couple of other things here, and so if we have some other questions coming up, just a quick reminder, again, the slide here, you can connect with us and follow us on social media if you'd like. More importantly, if you go to leftbrainpro.com/presentations, you can access, you'll see a list there. You can choose this seminar from today, this webinar from today. When you click on it, you'll be able to download the presentation. And on the right, you'll also see a list of links under the resources. My picture and contact information there along with Melissa. And we do have, again, 3 additional presentations already on the books with the Incorso platform. The dates and times that you see there and registration details will hopefully be available in the next couple of days. So with that, I don't know if you've got some questions for me coming in, or maybe if you have some other questions that came to mind for you, Liz.
Yeah, we have some questions. So first question's coming in from Ed, and Ed is wondering if QuickBooks has a government account template set up.
So that's an excellent question. QuickBooks does not, but one thing that we do have a chart of accounts template that we're happy to share with you. If you send us an email at support@leftbrainpro.com, we can get you a template over. And as you guys know, if you're working with QuickBooks, it's easy to add and change and rename and renumber accounts in there. So if yours doesn't match that, fixing it in QuickBooks is actually pretty easy to do.
Awesome. Thank you so much. So that email address is support@leftbrainpro.com. Did we get that right?
That is correct.
Okay, awesome. Very good. Thanks, Ed, for that question. Another question, Robert, you and I have talked about this in the past, and for our audience today, especially since this is the first of many topics, can you tell us a little bit more about who you work with? And I know you have engagements of all different types and durations, but maybe what like a common way that you work directly with a company who has a government contract, and then a common way that you might work with someone, a CPA in an accounting firm who has clients who have government contracts.
Yeah, that's a great question. So I'll tell you that one of the common questions we get from new or potential clients is they'll often call and say, we're working on a contract, and we're sending invoices and we're getting money, but there's just not that much money left at the end of the month. And that's always a signal to me that there's something wrong with your indirect rate structure and their pricing model, right? They don't fully understand their cost. And so at the end of the month, they've spent a lot of money. They invoiced based on some other formula that they put together, and there's some disconnect, right, between the cost that they're collecting and what they're actually invoicing to the client. And so not a surprise in that our accountants love to say the eroding profit margins, right? And that's what's going on. As far as other firms and what's really a great opportunity for both of us, what I told you up front what we do. What I didn't tell you is what we don't do. So we don't do any outsourced accounting. We don't do payroll. We don't do taxation. It's not our as a licensed CPA, obviously I've been trained in it, and I have done all of those things in the past at some point. But it's not something that we do in our firm. We do strictly the government contract accounting compliance. And what we find is that there are actually a number of other firms out there who are just the opposite, right? That you guys are doing monthly write-up work, you're doing outsourced accounting, you're providing payroll services, you're doing taxes for companies. And in fact, some of your clients may be doing government contract work, but you don't really know some of the details around that. And that's where we can work together. There's no, conflict of interest. We're not trying to take your business. You're not trying to take ours. And we can actually step in and help your clients that way by providing that government contract accounting expertise.
Wonderful. Thank you for that great overview. It is really helpful to hear that. Very good. Well, for the audience, we would love for you to check out Incorsa.com. We'll be posting registration links for Robert's upcoming presentations very shortly. And maybe, Robert, you could just give us another little glimpse into what we'll be covering on February 11th when we talk about the fundamentals of indirect rates.
Yeah, so on February 11th, we will dive deeper into fringe, overhead, and G&A. In particular, we'll dive into some more of the specific types of costs that comprise each of those pools. We'll talk about the typical base. So again, for things like fringe, we obviously already have talked about labor, but when we get into overhead and G&A, you have a couple of other options. We'll explain the various allowable allocation methods available for those pools, walk you through a couple of calculations, and show you where some of the pitfalls that people often fall into.
Excellent. Very, very good. Well, that brings us to the top of the hour. So Robert, thanks so much for your commitment to educating the CPA community and educating the Incorsa audience on these topics. You really have an excellent instructor learning style to teach, and we really appreciate that. So with that, we'll just do a couple quick housekeeping items to close. For the audience members who would like to earn CPE credit, if you responded to a minimum of 3 of those 4 poll questions, you'll be able to download your CPE certificate from your Corsa dashboard. The recording from today's presentation along with the handouts will be available for you to access in the future, also from your Corsa dashboard. Check out our upcoming programs and also connect with us on LinkedIn. Looking forward to serving you again soon. And Robert, we're looking forward to having you back on February 11th. So with that, thank you everyone so much, and I hope that you have a great rest of the day.